Chapter. We're talking real money.
As I sit happily in my lonely little cave of a studio and vocal booth here in Florida, the things I hear, for example, this text just came in from a Colorado area code where I used to live, area code 303. It said, "Are you busy tomorrow?" That was it. I sit here and get scams. Whereas Tom, because he lives the busy office life, he gets to hear from people about real stuff as opposed to being spammed by text messages.
No, I still get those too. Hi, remember me from ninth grade? Or I'm like, no, I don't. Thank you. Sorry, I don't recall. So,
are you busy tomorrow?
Are you busy tomorrow? Yes, it turns out
303.
I am. Yeah, that's wonderful.
I haven't had any girlfriends in Colorado for decades.
Yeah, let's keep it that way. What do you say? It's a fascinating time. You're right, because I get a lot of the questions. I get a lot of the calls. I talk to a lot of you. So I feel like I have a pulse on things a little bit. And there's a lot of crosswinds now, but it's also...
Can I help you before you go on? You have your fingers on the pulse.
What did I say?
You said you have a pulse on.
A pulse? Well, barely. It's slow.
You have your fingers on the pulse
erratic.
Of American money issues.
Oh, okay. Okay, that's good.
I'm just trying to help you out.
Pulse. Wait.
I'm going to be your artificial intelligence because you don't know how to use the real thing.
Making my rate, normally the resting rate is 61, but right now I'm running about 85. So you're really working me here. So take it easy. I
got to go put my watch on and see what mine is. Go ahead.
It's a fascinating time because at one level, the market has had, what did I just read this? 28, the S&P 500, 28 records have fallen this year. Woo! I mean, that's amazing, right? Just up. Yeah.
In answer then to the question, should I get in when the market's at a high? It's been at a high 28 times.
I know. It's a good point. And what that's meant is, there's the part that makes me nervous about all that. Number one, people are, in my mind, because I look at some of your portfolios, way overinvested in stocks. They've forgotten that at some point, stocks do go down. Number two, this is the thing we want to talk about today, all these speculative stuff. Open door technology. I was reading about this last night. A real estate tech platform is up 413% this year.
Wait. Is that a stock?
Yeah, Open Door Technologies. It's one of the new meme stocks. And it says, according to this article in the Wall Street Journal, at times accounted for 13% of the entire U.S. stock market's trading volume in a day. I mean, that's crazy. The rebirth of SPACs, there's been those again. And then perhaps most worrisome, frankly, for people who are just index investors, you don't probably know this number, the Magnificent Seven. You remember those guys, right? Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla.
How could you forget
them? You know what
They're...
percentage of the S&P 500 they now make up?
They're probably right at 30.
37%.
Oh, my God. They're almost to 40.
That is scary. So, okay, but what that has led to...
Well, what that has this one too.
Yeah.
Edit 2. Okay, go ahead.
What that has led to is many of you look at the market and think, whoa, what can I do to make more than just be in stock? So I got a call. This is a real call yesterday. Bill from
Buffalo.
Call,
not a fake call. No,
not a fake call.
Real. No, I didn't make this up.
I didn't make this up. He called about a special sports partnership. He'd like to take a quarter of his money. He's in his 50s. And here's what it buys. It buys you a partnership in a sports franchising business in the United States. Most of the teams are at the fourth level. I don't even know what the fourth level is in U.S. soccer. And I'm a soccer guy. I mean, I think you have the MLS, then the USL. I can't keep track of it all.
Wait. Isn't the fourth level elementary school soccer, Pee-wee soccer?
I saw the game, yes. I'm reffing the fourth level. And they suggested, they don't put this in paper, but when they call you and talk to you, the suggested annual rate of return is between 15 and 30%. And then they did give him a quote. This is investing in assets under management that are already controlled and operated and running now. In other words, they're not going to buy teams. They already own them. And he said, what do you think? I said, I'm not thinking. I wouldn't even consider that unless you're Bill Gates or something. This is not something you should be putting a quarter of your money in. Absolutely 110%. No way, right? Did I miss anything?
No, you haven't missed anything. It's dangerous. Heck, it's not just dangerous. It could be. Not saying it is, but we have had enough cumulative experience talking with people about financial issues and reading about them and studying them over the many decades we've been doing this to know that some of these things are just end up being outright scams.
Yeah.
And you can't tell the difference. You as an individual investor cannot tell the difference until it's too damn late.
Yeah, there's just one in the local media here about a real estate that turned out to be a Ponzi. Again, we're not saying that here, but let me read you a couple of these other questions we got just in the last week. This one from Joe, Palm Coast, Florida. He says he's 70 years old, focused much more on income creation than growth with sufficient guaranteed income. Income creation than growth with sufficient guaranteed income.
Yeah. What are the downsides?
Okay, you're going to love this. Well, I'm getting to all this. What are the downsides to utilizing derivative investment funds such as GPIQ?
Hold on.
Sounds real smart. GPIQ, right?
It's got a high IQ. Yeah.
Very.
GPIQ is, that's a covered call writing fund.
Which we've talked about.
They work sometimes and then they don't work other times. And there's downside and drawbacks to every one of these products. We could go through a list of them, but the list is many and varied. You give up upside. You sometimes end up in all kinds of option squeezes that don't really make sense and just suddenly happen. There's just all kinds of potential problems. And the problem is they look good when they look good. And then you
that's
don't
my
know.
Worry.
We've played this game about every 10 years for as long as I have been aware of the financial services industry, which is several decades.
Yeah, okay, but he gave me another one. How about J as in John, EPI, JEPI, lower than the S&P upside capture ratio of 87.5, but also has a lower than S&P downside capture ratio of 74.7. It has an SEC yield of 9.5% with an expense ratio 0.35, 1/3%, and literally too good to be true. He admits that in the email.
It's a covered call writing fund. Yeah. And again, they work when they work. So what they do is they buy NVIDIA stock. Then they sell someone else the right to buy NVIDIA at a slightly higher price at a date in the future. They collect a premium for that. However, if NVIDIA goes past that point, well, you give up the stock at the price you guaranteed to give it up, and you miss all that upside, if there is upside. You do get somewhat protected from the downside, but not protected really, because the only protection is the premium you receive. So let's say it was a $2 a share premium, and NVIDIA drops $5 a share. Well, basically you lost $3. You protected $2 with the premium, but it's not. These aren't magic. These have been around forever, and they have times when they do really well, and then other times when they do really poorly. And when they do really poorly, people stop pouring money into them. You're buying in now because we're in one of those times when they have been, past tense, doing really well.
That's what worries me. He says, with an expected time horizon of 10 to 20 years and no concern for inheritances, why would I not want to take advantage of the monthly payments that these funds are providing?
Because you're paying extra money for something that isn't and historically hasn't been any better than just doing a well-balanced portfolio and taking an income stream from both your growth and the income generated by the stocks and the bonds in that portfolio.
This is just so complicated to me. Okay, so then along these same lines, Ray writes us from Royalton, Vermont. Vermont.
VT?
VT, yeah.
That's Vermont.
Ticker, PCR.
What do you think it is?
For some reason I want to say Virginia, which is what I feel
Virginia
like.
has a T in it. Yeah, where's the T in Virginia?
I told you, this is it, man. I'm walking out the door, and I'm swimming across the lake, and that's that.
He lives in the state of vigilant and vitality.
PCR, the Simplify Vetify Private Credit Strategy ETF. P as in Paul, C as in Charles, R as in Roy. PCR. What say you?
What is a Vetify?
I don't know what
does that
Vetify is.
mean?
I was hoping you would be able to shed some light on that.
I have no idea what that means, but whoa, the expense ratio, ladies and gentlemen, boys and girls, it is 0.75% for an ETF. Ho ho! And this is an ETF that owns weird bonds, and they own lots of them, and they borrow money to get them. And I don't even know what's in the darn thing because they don't break it down. But the expense ratio, that alone speaks volumes. And the other thing is that this is a new gimmicky thing. It's been around for, I don't know, let me just look.
15 minutes?
Okay, 20. No, it's been around for PCR started. What is wrong with this chart? Morningstar, what is your thing is not working?
Pretty bad day then. Yeah.
It's been around. Is that correct? The fund started. Is that right? 9/23.
That would be what?
2025? Can that be right?
7 days or something?
Yeah,
so maybe that's why he's all excited about it, because it just came out.
Yeah, it's brand spanking new. Why are you guys paying any attention to this stuff?
That's what I'm getting at.
What idiot is selling you this?
This is the problem today.
Did you read about this on Market Watch? Oh,
somewhere,
gosh.
for sure. Wasn't it Joe Kennedy in the late 20s who said, when the shoeshine boy told me about stock picks, I knew the market had reached This reminds me of that, because all these new ideas, and here's an easy way to make a lot of money. That's really worked, by the way. This has worked for a week now. It really concerns me that you're paying attention to these things instead of looking at your situation.
Do you mean to tell you where they heard? Okay. Here, please. This has been my advice. I haven't given this advice in years. Then I'm going to
listen closely.
All right.
Yeah.
Here is my advice. Turn off CNBC forever.
And
You're watching. That guy's watching CNBC because this came out as a CNBC story 4 days ago. The headline is not just for the ultra wealthy. Two firms team up to create more access to private credit. Vetify and Simplify are two different companies, and I'm telling you, this has trouble written all over it. In an economic downturn, private credit is going to be the first thing to take a walloping. Oh, it's going to just be bloodbath city.
But stepping back, looking at our situation here and why you're asking us about these things and why you're thinking you should pay attention to these things, that's when, as I said, I used the Joe Kennedy analogy. But for anybody investing today, what I say, there's 28 new record highs for the S&P 500, which just points out, then who cares? But the market has gone up, a fair amount this year. You probably, rather than looking at the new product, should be checking your stock to bond ratio to see if you're out of balance. That would be one. You should probably be taking something like the risk quiz to find out what your risk tolerance is. And then, as you say, Don, your need for risk. What rate of return do you really need on your money? And you'll find out that you're probably in the right investments if you built this correctly, and you don't need to chase the special things that only the ultra-rich could get until yesterday.
And here's one of the things I love about these guys who are pitching this stuff. I was reading this article on CNBC. The head of the company, Simplify, Vetify, one of those two. Oh, Vetify, I think. He said, no, this is not for your entire portfolio. No. I view private credit as a portfolio diversifier. And I only suggest an allocation of 5 to 10% of your portfolio. Now, what is funny about that is the fact that everybody who's pitching a weird asset class, they say, oh, it's just a portfolio diversifier. You only want to put 5 to 10% of your money in commodities. Oh, it's just a portfolio diversifier. You only want to put 5 to 10% of your money in gold. Oh, it's just a portfolio diversifier. You only want to put 5 to 10% of your money in crypto. Oh, it's just a portfolio diversifier. You only want to put 5 to 10% of your money in private equity. Oh, it's just...
Is there any room for like the Standard
There's
Poor's
no
500?
room left after you've portfolio diversified
markets?
at 5 to 10% in all these things these guys are pitching
brilliant.
to make themselves rich.
Yeah, a lot of money.
Oh.
Yeah. So, again, always go back to the basics. Don't pay attention to this silliness that's out there, the froth that can really get people in trouble. That's the problem I see.
And ladies and gentlemen, here's an important piece of advice from Talking Real Money. As a community... What's the word I wanted to come up with? Oh, darn, I lost my word. What are those things called? Oh, public service announcement. There we go.
A public service announcement.
Ladies and gentlemen, here's a public service announcement from Talking Real Money. In your best interest, turn off CNBC and Fox Business and never turn them on again. Do you think it does you any good to look at that stupid ticker all day long? Does it tell you something you need to know? Are you getting any good advice? No! Never! Not once! Because even if you have Jack Bogle on like they did in the past, Jim Cramer is going to argue with him. Thank you. I'm done with my rant now.
All right. On to the question. Stacy writes us from Chapel Hill, North Carolina. Hi, Tom and Don. Love your podcast. Have a question about Roth conversions. We each have 401ks and have standard IRAs and Roth IRAs. We make too much money to contribute anything additional to a Roth outside of the 401k. So I'm going to stop there very quickly. You could, depending on your IRA balance, it says you have a standard IRA, do what's called a backdoor Roth IRA. You might want to look into that.
Yeah, but then you got people have to remember the pro rata rule.
That's why I said you might want to look into it.
If you have a lot of money in
then it's going to be painful.
Regular IRAs, you got to pay lots of taxes.
Yeah, I agree. We have only Fidelity and Vanguard low-cost funds. Yay. I'm 60. My husband is 65. Plan to retire at 65. He wants to work till 70. And we want to try to convert 500,000 of our regular IRAs. There's the IRA part. That tells you pretty much the back door isn't going to work. But we're in the 30% tax bracket. How would you advise we minimize taxes? RMDs are approaching. We'll soon be here. By the way, your RMDs, let's see. So you're both born 65. You're not going to start till 75. So you still have time. Thank you for your solid advice and integrity. I love the banter between the two of you. So, Stacy, do not do a Roth conversion when you're in the 30% tax bracket. That would be a bad idea.
What you could do, because you got that decade really between now and RMDs, and you're gonna, we're so worried about RMDs that sometimes we cut off our earning nose to spite our tax face. But maybe you could do don't try to do the whole thing. It's okay to pay you're going to pay taxes on it now or later. Hopefully later you'll be in a slightly lower bracket. We don't know.
Okay, thank you, because we've talked about this a lot, that people are caught up in the excitement of converting everything to Roth and forget that you may not need to do that. I mean, the reason to do that would be if it's going to force your tax rate up after retirement. For very few people is that going to happen.
And think about that for a minute. $500,000 in IRAs today, maybe $1 million tomorrow or 10 years from now when you have to take those RMDs. But the RMDs are like 120-something of the portfolio.
3.5% to start.
So it's $30,000 or $40,000 out of that portfolio that you have to take in that year isn't going to kick you into a high bracket.
Yeah, and I don't think Roth conversions are going to make sense for you until you stop regular income.
Yeah.
For most people, they don't, because you're going to pay too much in tax.
Even then, I don't know that they do, because
then you run them carefully.
Yeah, because you're paying the money to the IRS today.
Yep. That's right.
You
might or might not. There's nobody there to collect it. So does it really get?
That's true. But if you leave it there, you remember you're earning money on the money you haven't yet paid to the government.
May never pay. That's good. Pay your taxes. Apparently they need them. Kathy from Buffalo, New York writes, I'm 70, my husband's 67. We're buying a replacement primary home and closing by December 1st. I'm concerned if we don't sell our current home soon enough, I will need about $150,000 to $200,000 for closing. We both have federal pensions. I have about $600,000 in my TSP. My husband has $280,000. Schwab brokerage, $200,000 in it that I inherited in 2012 from my mother. Also have $50,000 in Vanguard funds and an inherited IRA with $60,000. Some IRA, blah, blah, blah. The question here on the table is how to come up in the most tax-efficient method with $200,000. Now, most likely the smartest place is going to be that brokerage account because you're only going to pay long-term capital gains tax.
I'm going to totally disagree with you.
Okay.
I'm going to totally disagree with the premise.
Oh,
there's a
don't buy the house?
No, there's a basic flawed premise here.
Yeah?
There really is. Now, right now it is October.
That's right.
Not closing until December. Worried that the house won't sell. Are you saying that no houses, where does she live?
Buffalo, New York.
Are you saying that no houses in Buffalo, New York are selling right now? No one is buying any real estate in Buffalo.
You've been to Buffalo? No.
You've not been to Buffalo. It will sell. Lower the price.
Assuming that she needs the money.
No, but lower the price. Then you'll get the money. Then you don't have to touch it.
That's not the question on the table.
I don't care. That's the actual question that underlies this whole thing. I hate it when people say, well, my house isn't selling. Then you're asking the wrong price.
You haven't met what people think is the right price.
Any house anywhere in America,
but assuming that
will sell.
Doesn't. Any house anywhere? Really?
Any house anywhere will sell at the right price. No. Okay. You have a house in a decrepit old house in the middle of Buffalo, New York, in the slums part. If I price that thing at $1, I'm going to find somebody to buy it. So it's just a matter of finding the right price.
All right. So fix the price, part one.
Fix the price.
If you need money, brokerage is going to be first because that's going to be taxed at long-term capital gains tax rate. You said you got the inheritance in 2012. I would also look at the other brokerage money you have at Vanguard because all the other ones are going to be taxed at regular income tax rates. That's the point I was trying to get to. But you're right. Fix the price first. You have 2 months to do it. So go for it.
Yeah, let's say
Dawn
the house
apparently is going to be a buyer at $1.
Let's say the house you're asking $500,000, and you have to go down to $450,000. Well, at least then you haven't touched your liquid assets. Your liquid assets are incredibly valuable to you as you are at retirement age. You don't want to, if you can avoid it, diminish those, particularly if it means what we forget is if we don't sell our house, now we're paying the price of 2 houses.
Yeah, it's fair.
So you have to factor that in on top of the tax bill. How much is that going to cost you?
It's not fun.
So I just, and it's funny, you only hear this in real estate. You really don't hear it in anything else. My stock won't sell. Yeah, it will. You know it will. Just put it in at market price. It will sell like that. Put your house on the market at market price.
Fix that first before looking at getting other money. That's fair.
Right.
That's how I'd put it.
If there is zero market for your house, then you're in a whole lot more trouble than taking and paying some taxes.
Has that ever happened? Was that the case in 08, 09, 10? I don't know. Maybe you're right.
No, you just had to lower the price enough.
Yeah, that's right. My neighbor dropped his by, when he got in trouble, had to sell it for far less than he thought it was worth. So when I sold mine, people thought you get way more. So no,
you just hit it on the head. What we think it's worth. When we get it in our heads.
Yeah. People said, you're way too low. I got to sell it. So I'm not. And I sold it. So I was right.
Well, yeah, you had to buy that other house on the lake.
I already bought the other house. That's what I'm saying. I've been in the situation where it's not fun to have more than one house payment, et cetera. Trust me, it's not a good time. I get that at the emotional side. Fair enough. So, all right.
There you go.
Answered all the questions, argued with all the funds, set it straight. How about that?
Gosh, another job well done.
I wouldn't go that far.
No, I think it was good. I think the episode earlier in the week was better, but this was okay.
It's okay.
It'll do.
Okay is good enough. It got done.
As long as we stay in the top 100 investing podcasts in America.
Way up lately. Yeah, way up.
Good. I'm happy.
Thank you for all your support.
Yes, thank you guys. You've done really well by us. You listen. Still don't know why, but thank you for doing it. And keep doing it. Tell your friends. Tell your neighbors. Tell your acquaintances. Tell people you bump into on the street. Just walk up and down the streets of your community going, listen to Talking Real Money. I'm not a lunatic. Listen to Talking Real Money.
By the way, would we give you a sandwich board if you're willing to do that?
Would you pay for it? Okay. Really? Oh, that's funny.
Kind of funny.
I had never thought of that. I'm usually the one who thinks up the wacky
You're
crap.
The creative guy.
Wow. Really? Yeah.
If somebody's going to do it, then yes, I will get them a sandwich.
Wait a minute. Let's find out. Custom.
God. Let me guess. $500. By the time you get the boards and you got to paint them and you got to do all the rest.
We need
a
wearable one. The wearable.
Yeah,
not just the standard one.
Wearable. No, you got to walk the street.
Oh, now they're really fancy. Now they're like banners that are backpacks.
Even better.
Oh, that's pretty cool. Oh,
Christmas is coming, so the opportunity is there.
They're just like a fabric banner that you wear on your back,
and
like those things at trade fairs. $125 for a backpack banner. So if you'll wear the backpack, send us pictures. You will get one.
Yep.
Of listen to Talking Real Money.
You
banner.
Call me, I'll get you one.
Yeah, but they've got to send us a picture.
That we made it happen.
Oh no, okay, but the deal is then they have to send us pictures of them wearing it at public events.
Oh yeah, that's true. We got to actually see evidence.
So you're actually going to pay $125
Sure,
for a
why
banner?
not? That'd be fun.
You're
I love
crazy,
it.
Man.
You'll design it.
It's a backpack. It literally is a backpack with a banner on it.
Rolls out. I love it.
All right. Gosh, I've never seen anything like it. All right, so call Tom. Send him a note at talkingrealmoney.com or whatever. Oh, wait, I just got a 5% off coupon.
Okay.
5 off. Use the code 5 off.
Saved a lot of money.
Save $6.
Woo. Well, every $6 helps, so.
Okay. We got to go.
Are we going to run that through compliance, or what do you think?
Probably have to run the sign through compliance, yeah, probably. We'll put our pictures on it.
Yeah, why not?
Okay. That's the nuts. That's
probably
the crazy.
Enough for
that is
today.
just the nutsiest idea I've ever heard. Anyway,
I had to be crazy today.
Call us with your questions on Saturdays, 3 to 5 Eastern, 855-935-TALK. Go to talkingrealmoney.com with your questions, or if you'd like to meet with one of our Appella advisors who are real fiduciaries and they're not going to try and sell you anything and they're not going to charge any money for a quick meeting. If you want to be a client, you got to pay though. And you do that by going to talkingrealmoney.com and clicking on Meet an Advisor. I remember what it says, Meet an Advisor. Thank you for listening to another exciting episode of Talking Real Money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.